Tom Lee is back with some more very, very bold predictions about the market and the geopolitical situation that we are in. And we are going into a very, very important day tomorrow with the FOMC meeting. We're going to get the interest rate decision, which they are most likely going to leave rates exactly where they are. But the Fed guidance tomorrow, I don't think everybody fully understands exactly how critical this is. We're going to be covering things here, guys, in this video that I don't think anybody else is talking about right now. So we're going to roll the clip, get right into everything, and explain the entire situation to you guys with what's exactly happening with the market so that you guys can use this information and go out and make more well-informed decisions for yourself. So before we get into all of that information, guys, if you guys do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you literally nothing to do it, but it helps me out a whole lot in spreading these videos out to as many people who actually want to learn what is really driving markets. Let's see if we can get this video to 500 likes, guys. That would be absolutely awesome. And if you guys never want to miss another video like this, make sure you hit that subscribe button and turn on notifications. But without further ado, let's roll the clip.
Joining us now for more is Tom Lee. He is the head of research and founder of Fundstrat, also a CNBC contributor. Also joining us, Nancy Tangler, Laffer Tangler Investments, CIO and CEO. Tom, listen, I understand it's a different White House. Every day we get a market-moving headline. A lot of people, I think, honestly, I'm just going to say it, they don't want to be neutral. They don't want to be data-driven. They want to be angry. I get that. But history says that markets will recover, right?
Yes, they've recovered every time. One thing we have to keep in mind is when markets fall this quickly from a 52-week high. I mean, just remember, less than a month ago, we were at all-time highs. That is a market pricing in a crisis. I'd say we're almost 50% pricing in a recession. And we're assuming there's no Fed put. Now, the Fed is in a position to cut rates. That really should mitigate the downside. And I do think two other things that investors have to keep in mind, because many people just want to get out until April 2nd, is number one, I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And it's simple to see because China, Europe, Canada, Mexico, since April 18th, all of those countries have outperformed the U.S. I don't think that markets are that blind to say if Canada and Mexico are about to have a recession, they should outperform the U.S. And I think the second thing people should keep in mind is that when you have a global crisis brewing, and we highlighted like the 1962 Cuban Missile Crisis, that was a 12-day crisis, but the markets bottomed 7 days into the crisis. 5 days before that crisis ended, the market was already recovered 2/3 of the losses.
So as you guys heard in that clip, it is very apparent that Tom Lee is sticking to his guns and maintaining his bullish stance. Now, drop a comment down below on your thoughts on whether or not you think Tom Lee is going to be correct in his thoughts on the market bouncing back significantly over kind of the next month and a half here. But we've broken down a lot of the main reasons why Tom Lee is so bullish in the past, whether that had to do with the relationship between investment grade corporate debt and the equity market, and a lot of the other different metrics here too, especially as it relates to this new administration coming in, slashing government spending, stopping the hiring of government workers, which is definitely going to have a drag on growth moving forward. But one of the main things that Tom Lee cited was this little development that we've had here so far. And this is something that we've talked about on this channel a little bit too. And I just want to briefly point at this here just before we move into the really, really important stuff. So this is FXI. This is the China Large Cap Shares ETF here. And as you can see, this has had a very significant move to the upside throughout the beginning of 2025. You are seeing a lot of this happen in foreign markets. US markets are down, foreign markets are up. You're seeing it happen in Mexico. You're seeing it happen in Europe. You're seeing it happen all over the world right now, that a lot of these other countries are outperforming US, especially those. Again, you can draw that conclusion that if a lot of these foreign markets that the US is putting tariffs on right now are outperforming US markets, well, if the tariffs are then meant to hurt their economy, well, the market doesn't really think that those are going to go into full effect here. Now, I want to bring back yields on here because we're going to need this a little bit later. But Some of the most important things that we need to think about here, guys, is going into tomorrow with the FOMC meeting. The Fed has really done a poor job of the way that they have relayed their thoughts over the last 3 months here. Now, this isn't just me saying, oh, the Fed is wrong and just kind of poking fun at them. We're going to go through an exact example of this from the FOMC meeting minutes that were released in January from the December meeting. Now, with regard to the outlook for inflation, participants expected that inflation would continue to move towards 2%, although they noted that recent higher than expected readings on inflation, so this was in the end of last year, and the effects of potential changes in trade and immigration policy, very important, suggested that the process could take longer than previously anticipated. Several observed that the disinflationary process may have stalled temporarily or noted the risk that it could. A couple of participants judged that positive sentiment in financial markets and momentum in economic activity could continue to put upward pressure on inflation. This is one of the most important pieces of, let's say, financial literature as it relates to Fed guidance that has come out really in the last 3 or 4 months here. What they are effectively saying here is that the tariffs are going to cause inflation. You're going to see the economy continue to move to the upside, and that they are not necessarily going to stick to what they said earlier or the market expectations that were held earlier, that there were going to be a significant amount of rate cuts coming in 2025. But what have we seen? Well, when we take a look at CPI here, we did move up a little bit on this year-over-year number in January, but our most recent reading, we came back down to 2.82%. Then, when we take a look at Trueflation, which what they do here is they're utilizing modern consumer and spending data sets along with cutting-edge technology to deliver the world's only verifiable daily inflation indexes. And when you look at what's happened over the last couple of months here on this Trueflation chart, it has fallen off a cliff. Oil is down. Eggs are down. A lot of these different commodities have been moving to the downside there. So what the Fed has done is guided forward and said, we do not think that we are going to be cutting rates as much as the market thought going into 2025. And that is one of the reasons why you saw, and this is why I needed to bring back the chart of the 10-year treasury yields, that is why you saw this aggressive movement to the upside in yields and downward pressure on bonds, okay? Just think about this, for example. If you think that the prices or inflation is going to be higher than expected going into the next couple of years here, and that the dollar is going to continue to devalue, we are obviously going to require a higher rate of return on fixed income assets, which is exactly what we saw here. But this move to the upside doesn't mean that the Fed is actually correct. And to expand on this point even further, guys, we have other branches of the Federal Reserve right now even confirming to us that this old belief that the Fed had and this thesis that this new administration was going to cause economic activity to continue to the upside, these tariffs were going to be really inflationary. Well, that's not actually the case because they failed to understand one very, very important principle about the American economy. It has been fueled by debt, government spending, and a lot of the labor market has been supported by the addition of a lot of government jobs. And that is not something that the Federal Reserve really wanted to come out and admit, either because they just didn't want to, or the fact that they just didn't realize that that was such a significant issue. Now, when we move over here, again, this is that other branch of the Federal Reserve that is telling us that these estimates and these projections that the Fed had previously really aren't that relevant anymore, and something most likely has to change. The Atlanta Fed GDP now, real GDP estimate for the first quarter of 2025 is now sitting at about negative 1.8%. Now, this has bounced back up a little bit more since these lows that we saw in the beginning of March, but that is still projecting negative GDP. Then when we come over and take a look, again, I believe we talked about this recently, or a little bit earlier in this video, we have CPI starting to move to the downside here. We also have consumer sentiment aggressively moving to the downside, which again is going to point to the strength of the consumer. If the consumers are not in a good spot, they're not going to spend money, and it's going to be very hard to stimulate growth. Do you guys see where I'm going with this? I'm not saying recession, but I am definitely saying there is a risk and a high risk of growth slowing down, which the Fed right now is really the only ones that can take swift action to make sure that that does not happen. So then we move over here. Just talking about the consumer even more, their real hourly compensation. So accounting for inflation, we were told in the third quarter of 2024 that real wages were growing at a rate of 1.6%, when in reality they were down 0.1%. So all of these different things, guys, are pointing to the fact that growth is slowing down. We have GDP moving to the downside. We have unemployment ticking up a little bit. And we also have a scenario in which, and this is where things get a little interesting here, this big red bar here was the hawkish cut in December, okay? This was the start of all the volatility that we saw in markets. This is the first time that we really saw this tariff risk starting to happen here, because the Fed comes out, they cut, they said they're going to be continuously data dependent. They don't think they're going to need to cut interest rates anymore. And we saw markets aggressively move to the downside going into the end of the year. They briefly rallied up, made new all-time highs, chopped around, and then the big tariff scare and trade war scare was happening here, which again, we've talked about this in the past, that it really is due to these slowing growth expectations rather than the direct effects and impacts of these tariffs here. But in order for, let's say, Tom Lee to be correct, or this market to find some sort of bottom here, the Fed needs to change their stance from a little bit of a cautious or kind of hands-off, little bit of a hawkish stance here to a little bit more of a dovish stance. And in my opinion, the data that we are seeing right now across the board is in support of that. And we are probably going to see a lot of questions on that tomorrow when they're going to probably ask about that GDP estimate or what they are actually expecting right now that inflation is starting to revert to the downside, or that the unemployment rate actually ticked up. You can see, guys, that all of these data points, again, are pointing toward the Fed being incorrect in what they were discussing in December, and they have the opportunity tomorrow to come out and not necessarily fix it, but change the stance that is going to be more realistic with what we are currently seeing with all of the incoming data that we have received in the first quarter of this year so far. So, guys, that is really going to wrap up this video here. Again, I really hope that you guys are learning a lot from these videos here. Something that you guys may not know about me is I have a finance degree. I went to school for finance, but I really don't think that a lot of that classic and formal education really prepares anybody for how to analyze the markets. I mean, I've been doing this since I was 14 years old. I'm 25 now. And my goal here is to really make sure I'm providing you guys with really better information than what most people out there have access to make sure that you guys can make better, more well-informed decisions, or at least be able to view the markets in a different way and make them a lot less stressful, especially in times of volatility that we are seeing in the present here. So again, that's going to wrap it up for this one, guys. If you guys did enjoy it, make sure you guys drop a like down below. Subscribe if you guys want to see more videos like this. But until then, guys, I'll see you in the next one. Actually, on the live stream tomorrow, we are going to be streaming FOMC. So if you guys want to stop by for that, we'd love to have you. But until next time, guys, peace.